Welcome to Spectrum Sphere, your portal into a diverse world of discovery. Today, we'll embark on a fascinating journey through the evolution of money. If you're passionate about history and economics, you're in the right place. Don't forget to hit that like button and subscribe for more engaging content every week. Money, in simplest terms, is a medium of exchange that allows people to trade goods and services indirectly. It's the lifeblood of our economies, functioning as a unit of account, a store of value, and a standard of deferred payment. Its evolution reflects the complex history of trade and economic growth. Before coins or bills, early civilizations engaged in bartering, the direct trade of goods and services. Imagine a farmer exchanging a portion of his harvest with a potter for clay vessels. This system required a mutual desire for what the other had to offer, a limitation that spurred the invention of money. While bartering allowed for direct exchange, it wasn't without complications. For one, the double coincidence of wants was a major hurdle, finding someone who simultaneously desired what you had and possessed what you needed. Additionally, bartering lacked standardization and a way to divide goods into smaller units, making trade cumbersome and often impractical. To address bartering's limitations, ancient societies introduced commodity money, items universally valued and accepted in trade. Goods like grain, cattle, and precious metals were common commodities. This type of money had intrinsic value, making it a more reliable and portable medium for commerce, paving the way for the monetary systems we recognize today. As trade became more complex, the need for a standard medium of exchange grew. Societies transitioned to metal money, minting gold and silver coins, whose value was inherent in their material. These coins were durable, universally valued, and could be easily divided, solving many issues of bartering and commodity trading. Moving beyond bartering, civilizations found a more enduring solution: metal coins. These coins presented clear advantages. They were sturdy, withstanding the wear and tear of daily use. Additionally, their ability to be divided made transactions simpler, setting the stage for a more standardized economic system. As we delve into the Tang Dynasty, we unearth a groundbreaking financial revolution: the invention of paper money. This novel concept offered a portable and convenient alternative to the cumbersome metal coins, radically transforming trade and economic practices in ancient China and eventually the world. From the ancient Silk Roads to bustling Mediterranean trade hubs, paper money began its journey westward. The ingenuity of the Tang Dynasty's invention soon caught on, spreading to the Middle East and later to European commerce, forever changing the landscape of global economic transactions. Amidst economic growth and increased trade, the need for a standardized monetary system became clear. Enter the gold standard, a pivotal moment where paper money gained a new level of trust, each note representing a promise that it could be exchanged for a set amount of gold. Now, the game changer, the gold standard, establishing a fixed exchange rate for international trade. Nations pegged their currencies to gold's value, ensuring stability and predictability in global markets. It was an era when paper money wasn't just paper, it was as good as gold. As economies grew more complex, the need for a central regulatory body became clear. This era witnessed the birth of centralized banking systems. These institutions were designed to manage a nation's currency and monetary policy and to provide a stable financial infrastructure. Moving from coins to a lighter, more practical form of currency, we saw the advent of promissory notes. These were essentially IOUs, formal commitments to pay a specified sum on demand or at a set time. They facilitated trade, requiring less physical movement of gold and silver, and laid the groundwork for modern banknotes. As economies grew, carrying precious metals became impractical. Enter modern currencies, paper notes and coins with values decoupled from physical commodities. Nations began to trust the government's promise of value, shifting from intrinsic to representative money, a monumental leap in the evolution of our financial systems. Paper money offered unprecedented convenience, stimulating trade and economic activity. It was lightweight, easily transportable, and could represent large sums, streamlining transactions. However, it introduced risks like counterfeiting and inflation, vulnerabilities absent in the tangible security of gold or silver. The integrity of currency now hinged on government regulation and public trust. As the world wars unfolded, the massive military expenditures disrupted global economies. Countries abandoned the gold standard to print more money, fueling inflation. Currencies fluctuated wildly as confidence waned, precipitating a shift in monetary policies and international economic relations that would reshape the financial landscape for years to come. In the aftermath of World War II, nations sought economic stability. This led to the Bretton Woods Agreement. It pegged global currencies to the US dollar, which itself was convertible to gold. This created a new world order, where the US dollar emerged as the dominant reserve currency. As countries around the world looked to rebuild their economies post-World War II, the US dollar was adopted as the primary reserve currency under the Bretton Woods Agreement. This pivotal move solidified the dollar's influence in international trade, establishing it as a global monetary anchor. In a historic shift during 1971, the Bretton Woods system collapsed when the United States unilaterally terminated the convertibility of the dollar to gold. This effectively marked the end of the gold standard, propelling the global economy into an era of fiat currencies not backed by physical commodities. Fiat money is currency that a government has declared to be legal tender, yet it isn't backed by a physical commodity like gold. Instead, its value comes largely from public trust, and its supply is controlled by monetary authorities. It's the bedrock of our modern economy, allowing for efficient trade and economic stability. As economy expanded, physical money proved limiting, leading to the emergence of credit systems. Modern banking took root, revolutionizing transactions. Banks could now lend money they held on deposit, extending credit beyond existing cash reserves. This financial innovation marked a pivotal shift in how money was managed and multiplied. Enter fractional reserve banking, a system where banks keep a fraction of deposits in reserve and lend out the remainder. This practice amplifies the money supply as deposited funds are multiplied through lending. It's integral to our economy, yet it raises questions about the nature of money and financial stability. As we steered away from physical currency, electronic money revolutionized the game. Digital transactions now allow for instant, cashless payments across the globe. This shift not only offers convenience, but also signifies a critical evolution in how we perceive and utilize money in our increasingly digital world. Credit cards have become a linchpin in modern economic systems, enabling consumers to purchase goods and services based on their creditworthiness. This shift to borrowing on credit has accelerated consumer spending and economic growth, while also raising questions about personal debt and financial security. Transitioning from the physical to the digital, online banking revolutionized how we manage our finances. By simply clicking a button, we can now transfer funds, pay bills, and check balances, all from the convenience of our devices. This digitalization has made banking more accessible and efficient than ever before. The 2008 financial crisis was a stark reminder of the fragility of our monetary systems. Rooted in poor money management and high-risk financial practices, it led to a global recession, eroded public trust, and showed just how interconnected and volatile modern economies can be when handling money irresponsibly. In response to economic crises, central banks may turn to quantitative easing, a process where vast amounts of currency are injected into the economy to stimulate financial activity. While this can prevent economic stagnation, it often dilutes money's value, raising concerns about long-term inflation and the devaluation of currency savings. The trust we place in our money is the bedrock of modern economies. Without belief in its value, transactions grind to a halt, savings diminish, and the economy can collapse. This trust is underpinned by the stability and reliability of governmental and financial institutions that manage our currencies. As we progressed further into the digital age, a new player emerged to challenge the traditional concept of money: cryptocurrencies. Bitcoin and its peers introduced a decentralized form of currency, offering a level of anonymity and freedom from central bank controls that had never before been possible. Bitcoin, the first successful cryptocurrency, operates on a technology known as blockchain. This is a decentralized ledger that records all transactions across a network of computers. It ensures security and transparency, as once information is added, it cannot be altered, creating a trustworthy and permanent record. Moving away from traditional banking, digital currencies introduce a novel concept: decentralization. By eliminating central authority, digital currencies like Bitcoin empower individuals through a peer-to-peer network. This transition can potentially democratize finance, granting access and control to the masses over their economic transactions. Cryptocurrencies aren't without their controversies, particularly their environmental footprint. Mining, the process of validating transactions and creating new coins, demands immense computational power. This translates to substantial energy consumption, often from non-renewable sources, leading to significant carbon emissions which contribute to the pressing issue of climate change. As cryptocurrencies grow in popularity, governments worldwide are grappling with how to regulate them. These digital assets present a challenge to traditional financial systems, with concerns ranging from tax evasion to investor protection. Some countries have embraced the trend, while others have imposed stringent regulations or outright bans. The potential future of a cashless society beckons, with many nations already incentivizing digital transactions. This shift could streamline trade, reduce crime, and increase convenience. However, it also raises concerns about privacy and the digital divide, questioning if everyone will have equal access in such a future landscape. In a world devoid of physical money, transactions might become swifter and more efficient, while the risks of theft and loss minimize. Yet, there's a downside: possible cybersecurity threats and exclusion of those less tech-savvy or without access to digital infrastructure, sparking a debate on financial inclusivity. Shifting to modern monetary theory, or MMT, which challenges traditional views on government spending and debt. Proponents argue governments controlling their currency can create more money to fund programs without causing inflation, sparking debates on fiscal responsibility and the true nature of money in a modern economy. Inflation and deflation are like the economic tides swayed by the money supply. When there's too much money chasing too few goods, inflation rises, eroding purchasing power. Conversely, deflation occurs when money's scarce. Prices drop, but so can demand, potentially stalling economic growth. Both phenomena shape our financial landscape profoundly. Central banks play a pivotal role in shaping economies by regulating the money supply. They wield tools like interest rates and reserve requirements to ensure monetary stability. By adjusting these levers, they aim to control inflation, encourage job creation, and mitigate financial crises, guiding the economic ship with a steady hand. As we traverse the globe, we find a tapestry of currencies, each with its own value and stability. From the robust US dollar and euro to emerging market currencies like the Brazilian real and Indian rupee, the exchange rates between these reflect their economic interplay and shape international trade dynamics. The stability of modern money hinges on complex economic systems and the trust of its users. Looking ahead, experts ponder the viability of current models amidst technological advances and shifting geopolitical landscapes. Will digital currencies reign, or will traditional forms adapt? The future of money remains an open question. Hyperinflation is a harrowing chapter in economic history. When currency value plummets and prices soar, the consequences can be dire. Societies have seen life savings wiped out overnight, and governments topple under the strain. These cautionary tales underscore the delicate balance needed to maintain a stable currency. Shifting gears, let's delve into the Universal Basic Income, or UBI, a concept reimagining the very essence of currency distribution. UBI proposes that a government ensures all citizens receive a regular sum of money unconditionally. This radical idea challenges traditional perspectives on work, value, and the role of currency in society. As we transition from the global scene to specific examples, let's observe the Chinese digital yuan. This innovation marks a significant development in central bank digital currencies, CBDCs, reflecting a pivotal shift towards modernizing traditional money. This digital currency aims to streamline transactions and integrate economic policies in the digital age. Central bank digital currencies, or CBDCs, offer numerous benefits, including improved transaction efficiency and reduced costs. They can enhance financial inclusion and give central banks better monetary policy tools. However, there are concerns about privacy, cybersecurity, and the potential impact on traditional banking systems. Let's delve into these aspects. As we've journeyed through history, it's clear that money has continually transformed, adapting to our needs and technologies. From primitive bartering to the complex banking systems of today, each stage reflects humanity's ingenuity in solving the timeless problem of how to facilitate trade and store value over time. In the domain of currency, cutting-edge research and innovations never cease. Scientists and economists are pushing the boundaries, exploring advanced digital currencies, enhanced security features for transactions, and even the potential integration of AI to predict and stabilize economic fluctuations, ever molding the future's monetary landscape. As we look ahead, the future of money teems with possibilities. From blockchain advancements to the rise of digital currencies, the way we transact is poised for transformation. Imagine a world where currency is global, decentralized, and seamlessly integrated into the digital fabric of our daily lives. Grasping money's history is crucial for personal finance. It teaches us value fluctuations and economic shifts, equipping us to make informed decisions. By understanding the past, we can better navigate present financial waters and anticipate future trends, ensuring our personal wealth remains secure and grows over time. As we've journeyed from barter to digital currencies, it's evident that money's true value lies in the trust we place in it. Whether it's shells, coins, or bits of data, our collective belief in its worth underpins the global economy, shaping societies and influencing the dynamics of power and prosperity. And with that, we wrap up our exploration into the captivating history of money. We hope you found this dive into currency as enriching as it was informative. If you've enjoyed this journey with Spectrum Sphere, don't forget to hit the like button and subscribe for more fascinating content. Thank you for watching.